I remember I had 2,100
Bitcoin.
and I thought I was the greatest investor in the history of all time when I sold it for $1.
Chris, I'm sweating after you told me that.
I would punch myself in the face every morning that central banks really were very concerned about inflation. Inflation was taking off to double digits. They had to get that under control above all else because that would have had massive economic consequences. The fact that central banks are doing it, you always watch what they're doing, don't listen to what they're saying.
Yeah, that's a good way to put it.
I made enough out of that to retire from teaching.
Hey guys, welcome to this week's special episode of the Tapping Into Crypto podcast. With me today, I'm joined by Chris Tipper. Chris, welcome.
Hello, thank you.
So-
Thanks for inviting me along.
Yeah, mate, it's good to have you. I think it's a bit of a special treat for everyone out there listening. But so Chris, if you haven't heard of Chris, he is the chief economist and strategist at Ainsley Wealth. Been there for many, many years. Chris, I actually just want to throw it to you so you can sort of give everyone a rundown of, how you sort of started with Ainsley and your sort of journey into crypto to begin with.
Sure. So, the Ainsley angle sort of came after the crypto angle, interestingly for me. But so I might start there. I was actually very early in Bitcoin, as in a couple of cents early.
Oh, wow.
So I used to be a high school teacher, a high school business and economics teacher, and you're always looking for stuff to engage the kids, and they were very interested, particularly seniors, in trading, right?
Yeah.
So it was something that really caught their attention.
I remember the trading game kind of captivated a lot of us.
Yeah, that's right. But we wanted to do it with a bit of real money. So you'd
okay.
find stuff that you could put a little bit of money into and do. So somehow, and I don't remember exactly where it was, but it was very early and Bitcoin was just mentioned. It was sort of that white paper time. Not that I'd read the white paper or anything like that.
Yeah, okay.
But we were doing lots of investments. So it was something to throw some money in. So it was, I remember I had 2,100 at
Bitcoin.
a couple of cents, and I thought I was the greatest investor in the history of all time when I sold it for $1, because that was a phenomenal return, right? You got to think of percentages.
Oh, it is. Yeah.
So that was the start of my journey, and then the price obviously.
Chris,
went
I'm
up.
sweating after you told me that.
It is.
You said
I used
off
to tell
camera.
the kids.
Yeah.
I used to tell the kids
Yeah.
I would punch myself in the face every morning.
Yeah.
After that, what happened next? But it's just interesting because then I was so dirty when the price kept going up. I refused to look at it again because it was, the kids got me back into it about probably $60 or something, which was still absurd. I mean, of course, no one can hold it over the long term. No one's still got it.
Yep.
But when you look back at that and do the maths, it's a big number.
What would it have been like to even access it back then? I remember trying to buy in 2017. It was hard enough.
Insane. It was, you were buying it using PayPal on sites where you would effectively give an address over, they would give you...
Oh, they flick it back to you?
Flick it back. And I think it was that original wallet that was also the miner. Like
right.
It was,
yeah, I remember that bit. Yeah, sorry. It was all in one.
Yeah, I didn't really know what I was doing with that side, but you just did it because it was really just we're looking for alternative investments.
Yeah, yeah.
So that was quite interesting. But
okay,
where we sort of headed from there, because I was so dirty at Bitcoin going up, the kids were convincing me to get into XRP, or Ripple as it was at the time. So,
do you remember the approximate year that this was?
Well, it would have been before, maybe a couple of years after that. So, I don't know, 2015, 2014, 15, somewhere around that maybe. Yep. But I actually did that because I had a classroom game set up that was a reward system. And Ripple was so cheap, it was a fraction of a cent. So I'd use them because what had happened originally, I started with these printed paper credits.
Right.
So you get these things, but there was a great counterfeit hyperinflation that happened in my classroom because you could buy stuff with it. You buy chocolates and like a can of Coke and stuff back before the red food rules wouldn't let you sell any of that.
Yes.
So the kids would buy all this stuff, but some of them had figured out. I color printed them and everything. They got the color photocopier, the laminate. They'd done the whole works. But so to solve that problem, I went to a blockchain-based solution. So those kids, if you go back on the Ripple ledger, they were some of the very early
Ripple adopters
users. And we were using it legitimately because I needed a counterfeit solution to all these kids.
Let's look at the SEC. That was a real use case right there.
That was. So, we dodged that. Yeah, can you imagine today?
Oh, that's awesome. And then I guess, how does that sort of all lead to Ainsley for you then?
So really for me, it was that 2017 bull run.
Okay.
I made enough out of that. Even though you gain and lose it all in those early days. I made enough out of that to retire from teaching, and I was moving the crypto into gold.
Right.
And that was really because you just saw it was a huge run. I mean, Ripple at that point was $4.
Yep.
So it had just gone up, and I went, this is crazy. I've got to move it into something that I know. I knew gold and silver a little bit.
Okay.
And Ainsley was where I was trading it. So I'd go to Ainsley and swap my crypto. They were the first to do that in a face-to-face sort of way. So, started there. They were flat out busy because there was no one else doing it.
No, not at all.
And they needed all the help they could get, and I've just never left since. So that's sort of where I ended. The retirement was about 30 seconds, and then we were back into there. And since then, really today my focus is on what we've got, as we've just launched a fund which is for wholesale investors, but the Bitcoin and bullion fund. And that's really about bringing those two things together, that journey that we followed sort of the whole time of going, well, where should we be? It's really what I was doing back in those early days. You make some profits in the crypto. Where do you put it?
Right.
Makes sense.
And would you say that's the majority of your role at Ainsley, just being that strategic advisor as to how?
And the chief economist stuff has been really interesting because we've gone down this path of what I'd love to talk about today, where we look at global liquidity, some of these things that really matter, and we've found some really strong correlation to what actually drives the price of Bitcoin and crypto. So that's been really exciting to be a part of, and that's probably what takes up most of my time, just thinking about what's going on in the world and trying to lock that down into strategy.
Well, it's a nice segue because that is exactly what we're here to untap. I mean, if I were to sort of dig in, some of the conversations that I've had recently with just friends, acquaintances, even just co-workers, it's people that have been in it for weeks, months, years. They're kind of, I'm finding at this moment, all of a sudden converging at the same idea of, is it all over? I guess we've seen over the weekend, Bitcoin crash into new all-time highs. A lot of people a bit shaky and worried that this even happened on a weekend. Oh, what's going on? Should we be worried? So I guess that's what we're going to unpack today. Is this the last hurrah for Bitcoin? Or, let's speak to some of those key drivers that you spoke about. What is essentially, from your measurements, driving the Bitcoin sort of market forward, even from today? And I want to start off firstly by just unpacking one of your latest reports that you kindly shared with me, just a little bit about that global backdrop, that sort of macro lens that you applied to the way you think about the markets. And you've currently labeled it as a bit of an early cycle. So, for our listeners at home, just speaking to, I guess, what you've sort of overlaid there to explain that definition or label of early cycle, what does that mean? And then what does that mean for Bitcoin?
I think you're hitting the nail on the head of the bit that's causing the confusion for most people, because when you see early cycle, there are characteristics at the moment that would also indicate potentially what people consider late cycle and be worried about, are we heading into a bear market? So early cycle for us is particularly looking at the macro economy. So looking at the economic indicators when you put all of those together. And what it really breaks down to is two really simple parts, which is growth and inflation. So while you've got growth picking up and inflation not really being a problem yet, you're still early cycle. When you get to sort of mid-cycle, you're starting to have that inflation really pick up. And late cycles where you've got roaring inflation and the central banks and people have to come in to solve that inflation problem, which ultimately crashes the market. So,
and that would be best described what we saw in 2022?
Yes. So a lot of what we saw coming out of COVID was really, there was so much stimulus, there was so much money put into the system, which is the other part of this liquidity part, that central banks really were very concerned about inflation. Inflation was taking off to double digits. It was really a big problem. They had to get that under control above all else, because that would have had massive economic consequences. So we absolutely, at that point, were in that sort of late cycle and heading into a bust that was driven by the reactions to that late cycle. So right now, if you were just looking at that aspect, the early cycle part of it, you'd say, well, the signs are there for early, probably teetering on the edge of mid, but we're not at the end for the economy. Where that gets tricky is when you look at global liquidity, which is the driver of that cycle. It's the driver of the price of Bitcoin. It's actually the driver of pretty much everything. You go, oh, okay, that's starting to change at the moment. And that's due to some very specific government policies that are coming out that are sort of changing the way that the market works. Okay. So if you were looking at it traditionally, and a lot of people will be looking at their 4-year cycle, they'll be going, well, based on where we are right now, we should kind of be expecting the top. And that aligns with a little bit with that liquidity, but not necessarily with where we are in the economic cycle. So that makes it a bit confusing.
It's almost like that, it's sort of got a rhyme to it. It's not the same, but it rhymes. I think that whole 4-year cycle thing has got a lot of people sort of definitely like very stuck in their ways, and they're just unfortunately like you said, when you have a money printing cycle like we saw with COVID, it's really hard to see how the world is the same afterwards. So I can understand why people are still very much subscribed to that 4-year idea. But let's just double click on that whole, foundational idea of liquidity, because I know that gets thrown around interchangeably sometimes. People that are trying to do their own research, they sort of stumble and fumble as to actually understanding what it means. Could you sort of give some explanation to what that is and why it relates, again, like you said, so correlated to Bitcoin and other markets?
So I think the biggest mistake people make is they look at M2, which is the money supply that's reported easily. The reason they look at it is because it's easy to find, because it's reported everywhere.
Yep.
When you look at that M2 figure, it's only a fraction of the total that makes up global liquidity. Because what global liquidity, in really simple terms, all it is how much money is sloshing around in the system.
That's a good way to put it.
And it's always going up, right? Like it's always going up and to the right, because it's effectively a Ponzi scheme, the fiat currency system that needs more money to pay off debt and inflates it away. That's just how the system works. But it's not so much about it going up and to the right, because we know that's going to happen. It's the rate of change that it's moving that creates the problem or the opportunity, particularly in assets like Bitcoin. So for that simple definition, it's the amount of money that's there. The M2 is one component. The other components are really the capacity of people to borrow. So if you think about businesses that want to expand, well, their capacity to spend that money is going to be dependent on their capacity to borrow more money into the system. So a lot of what makes up the rest of it is actually the volatility in the bond market, which is a complicated thing that no one understands. But volatility in the bond market makes up a big chunk of the real number of total liquidity. And also the US dollar makes up a big chunk, because most of the world is priced in US dollars. There's a lot of US dollar reserves around. So if the US dollar goes up, global liquidity actually takes a hit, because it means everywhere else in the world is finding it more expensive to service their debt. So there's a lot in there that could be unpacked, but in simple terms, it's actually not that difficult to measure if you're just looking at that rate of change. And the rate of change going up has a very high correlation to the price of Bitcoin, crypto, and other assets going up. What we've seen recently that is starting to potentially raise some alarms is a flattening. We're not seeing the central banks, that component, the M2 component, coming to the party. They're not really coming to the party anymore. And that's what I was alluding to before about some real significant changes in government policy around how they're approaching it.
Yeah, okay. And like when you're speaking about the central banks, like are you talking specifically about them, providing more public like debt through, private vehicles to just increase the amount of money that's circulating? Is that sort of what you're alluding to there? Sort
of. So everyone's probably familiar with the main central bank function of changing interest rates, right? So when they change interest rates to lower interest rates, it allows more people more capacity to borrow and kickstarts the economy. But that's only one aspect of what they do. They also are dealing a lot with what money the banks have access to. So the real way that they can juice the economy, what quantitative easing was, which is a term that everyone would have sort of heard talked about, is really where they're providing capacity and funding to banks. So they might be going, for example, one really good example is they might be going, look, give us your old bonds that really aren't very liquid at the moment, no one wants to buy them, give us them and we'll replace them with new ones. Doing that makes the bank more liquid because they've got something they can sell and quickly convert into more cash reserves and keep that whole system running. So it's a little bit more complicated than just providing it to the end consumer. In fact, they rarely provide it to the end consumer, unless it's just COVID where they're printing stimulus. But they rarely provide it to the end consumer. What they do is they grease the wheels that make the whole system work by tightening it or loosening it. And the problem that we have at the moment is because that inflation is still, it never got to their target, never got down low enough. 2%, they're still keeping it pretty tight. So they're not the people who are providing the liquidity. At the moment, it's now shifting, particularly under Donald Trump, it's now shifting to more being led by the Treasury. So actually government spending, creating it. And why that's important for us as crypto investors, as people interested in Bitcoin or any of those crypto assets, is the pathway to finding its way to those assets is a little bit different. Because we've seen in the past a very direct correlation with when they juice that bank money, it finds its way into assets. When you give it to the real economy, could be a bit of a different playbook.
And is that kind of, I guess, something that you're paying attention to right now, just the way that that's sort of interacting? Because it is a new, almost sort of a release valve for the market or way
Absolutely.
of working?
It's so what we do every Monday, we have an investment committee meeting as part of the fund, and that is our absolute focus every Monday at the moment. Because if you were to go by that economy start part that we said early cycle,
Yep.
when you look at the liquidity, there's signs that we're very close to the end of that liquidity cycle. What's that going to mean for the price of Bitcoin sitting in the middle? Because if we were at the end of that liquidity cycle, we would be expecting the bear market to be around the corner.
Yep.
Our timeline on that has always been sort of late this year, pushing back into early next year for the liquidity cycle part. But when you factor in what the governments might be doing, that changes things, because then there's a lot of that still to come.
Okay. And when you're talking about what the governments will do, we talked about measures like rates coming down. Is there anything else that you're kind of looking at as like a forward measure?
It will really be really watching that government spending.
Yeah, okay.
And if it is going into areas that do promote growth, because if we see that growth picking up, like that's the intention. It's always the intention.
Yep.
Every government's intention is always to grow their way out of the debt situation.
Yes.
When the debt is so large, they can't.
Yeah.
Like the reality is they can't, but they can give it a good try.
Yeah.
And we've never really had all aspects of government aligned on this before, where they go, we don't care anymore about the consequences, we're just going to spend to grow. So that could keep it going. The concern I have is whether that is enough to really kick that overall liquidity up, because the central bank one, when you think about it, they've got unlimited capacity to continue providing more liquidity to the system.
Yep.
So central banks can keep this party going.
Mm-hmm.
The government, not so much, because they have a lot of other impacts, whether it's even just political impacts of what people are prepared to tolerate. And they don't necessarily have the valve to solve the inflation part of it when that picks up either, because you think, what's the government going to do? Cut spending? Like, that's not very popular, particularly if you're going into an election.
Yeah, and especially if you're in growth mode, right? You go into this opposite regime of where we were in, again, just only a few years back. How do you think the impacts of something like the tariffs, which you saw be a big theme at the start of this year, caused a lot of volatility, a lot of things to be repriced? What do you think that will have as an impact going forward? Is that something you guys are keeping a track of?
We're very concerned about something I think the market has missed, which is that Supreme Court challenge on the tariffs. If the tariffs were to be rejected, we're in two minds about whether that's positive or negative. Certainly in the short term, it could be very negative, because remember I said for that global liquidity, one of the big components is the bond market. The bond market you do not mess with. So the original, remember when I think the Trump administration was coming out, they were talking about huge tariffs on China.
Yep.
And the bond market started to wobble that night.
Yep.
The next day, oh no, we're just joking. That's off in the future. We're not going to do that anymore. Like that, no one messes with the bond market, because ultimately that blows everything up. So they have to keep that happy. When you talk about the tariffs, the concern is that if the tariffs that were removed or potentially removed by the Supreme Court, if they don't agree, were all the blanket ones on countries like Australia, the 10% or those percentage ones. So that's a fairly large tax income source if you're the US government that's just going to disappear. So then the bond market is just going to have to print more money to fill that gap.
Yep.
So that's where it could have a tantrum. Rates could spike up, which is not what you want when you've got a lot of debt that you've got to roll over.
Yep.
It could lead to significant consequences. We actually saw the equivalent of this in the UK when Liz Truss came in. I don't know if you remember there was a head of lettuce. I love the head of lettuce story where will the UK Prime Minister last longer than the head of lettuce? She did not.
Yeah.
And that was because she was effectively trying to do radical policies that would have blown up the bond market. The bond market is the boss.
Yep.
So that's a concern. If the tariffs are left to go, that could be fine. But then that's why we're not quite sure what the outcome will be. It might have immediate volatility for sure, but it could actually be very positive for liquidity, because then it would give the administration opportunity to go, in the US, to go, oh, well, we tried. We can't balance the books, so we'll just print our way out. And does that open the floodgates more? Hard to say.
Yeah, it is a tricky one. But I guess just sort of measuring back to a few of the points raised there, like, is the general thesis there that, again, we're not going to see the liquidity, as you're saying, which is a huge driver for Bitcoin, come from places where we expect it to come from in the past, but we're more likely to see the governments continue to ease than restrict right now? Is that kind of what's leading towards this whole thesis of there's room to move?
Yeah, so just have that separation of the government versus the central bank here. So you've really got fiscal policy or the policy of the budget stepping up, where the monetary policy of adjusting interest rates is just not really going. If central banks are doing what they academically are supposed to do, they're going to struggle because interest rates are not going to give them enough leeway to do it, and they're trying to keep it going as long as possible with the system as it is. So, but on those two aspects, the governments have given no indication whatsoever, and that's both sides of governments all around the world, that no one's talking about austerity, no one's talking about tightening the belt. They're all talking about reducing the system. So there'll be more money there. Ultimately, all of that leads to inflation and currency debasement. Long term, there's really only two assets that have so far proven themselves to be the antidote to that, and that's gold and Bitcoin. Well,
that's a nice little segue, because that was my next question. We have seen obviously gold soar and soar and soar. A lot of people may be in disbelief at the rally that we've seen come off of it, and it's not really at the moment looking like it's slowing down at the moment. How do you sort of rationale that movement into what's happening? Again, I guess we're talking about currency debasement here again, like just the fact that the market's moving towards a more solid source of money, and just the whole idea of that Bitcoin isn't really, well, it started to move now. It's not fair to say that it's not moving, but how do you guys sort of weigh up that relative strength between the two?
We've seen some really interesting research that suggests that it's kind of the same play with Bitcoin. To answer that last bit first, that we might see when gold peaks and stabilizes a bit, some of that flow then goes in, because it often happened with silver, and it does happen with silver as well. You sort of get that later flow into silver because gold becomes too expensive and people go, well, I want the more value play. I wouldn't be surprised to see that aspect happen with Bitcoin as well, that you see gold sort of pause in its rally, and then some of those flows really come into Bitcoin as the undervalued relatively speaking of the two. But ultimately, the gold price move at the moment has been driven by central banks. It's only very recently that retail has been knocking down our doors. We're flat out at the moment because people want to get their hands on some gold. But central banks have been buying to such a degree that recently the central bank holdings of gold overtook their holdings of US Treasuries.
Wow.
Now, that's pretty significant to your point about diversification away from the dollar, away from debt. So the fact that central banks are doing it, you always watch what they're doing, don't listen to what they're saying.
That's a good way for it.
That really tells you that they believe that there is a fundamental debt problem and they need to be diversified away from simply holding that debt. And particularly big players like China, they've been making massive purchases. For quite a while, they haven't been letting any gold out of the country. They keep it sort of all internally, but and buying a lot, moving a lot in, because they're very concerned about the potential for those bond market wobbles or something to happen that really decimates their currency because they're holding a lot of treasuries.
Okay. And when we talk about, again, just going back to the idea of like Bitcoin being that, let's call it gold 2.0, just more transferable, storable, all those sort of things. Have you guys sort of seen the measurements in the data that you're looking at, let's say last cycle, 2021, 2017, like has it kind of always been this sort of same dynamic? Like obviously we see Bitcoin and gold and stocks as points where they're in correlation, points where they're out of correlation. Do you feel like the thesis this time around from the market is different, just with the market structure changes we've seen with the ETFs and whatnot?
I think, and I'd never say this on a gold podcast, but I'll say it on this one. I think that Bitcoin is absolutely, like, I think you can quite literally say it's gold 2.0. And the way it's tracking global liquidity tells you that. It's at the moment it's responding exactly the same as gold, but with a multiplier on top, which is the adoption. That's it. So the data is very clear on that aspect, that we're talking about a in many ways better version of gold. The only thing it's not better in is it hasn't been tested for 5,000 years.
No.
So you don't have that aspect. But for every other aspect, the ETFs, the US government legitimization of it, it's serving that role. And while we might not see central banks tripping over themselves to get their hands on every last Bitcoin out there, that will be more of more of a feature of the relatively young nature of it than anything else. Certainly every other aspect of how it's behaving is consistent with its sole purpose being store of value.
Yes.
Same as gold. Gold's a pet rock. Doesn't make any sense unless you look at it as a store of value.
Yeah.
Bitcoin, kind of the same.
Yeah, absolutely. No, I couldn't agree more. And a lot of people get sort of caught up in this whole notion of short-term gains. I think that's the big difference that we probably will see the tide shifting, everyone moving away from this. Hey, Bitcoin could make 30%, 60%, 80%. I think everyone's just going to get to a point where you either, I don't know, choose you're either in or you're out, right? Like it's been that way for a long time, but I don't know, definitely in my circles, a lot of people just finally like giving in and just doing what they should have done a long time ago, just put little bits in, as I've always told them, but that's fine. But I think, I think at the end of the day, I don't know if you agree or not, like I just don't know if the market structure shift we've seen means that there's no bear market. I think if you choose to take on a risk or you choose to not take on risk, you've got to make that call for yourself. But I mean, are you guys sort of still planning for that sort of downturn?
There's nothing more certain in my mind than there will be a bear market.
Yep.
It's what's been confusing us lately is what is going to be the driver of that, because we see that government spending still coming. But what's becoming clearer to me is it's in the subtlety of what we were talking about. It's in the subtlety of where that spending is. Because if it's government spending and that's finding its way into the hands of consumers, the first assumption you're going to make is, if it's finding its way in the hands of consumers, they're all going to buy Bitcoin with it. But COVID spending was very different. That was checks where no one had anything to do other than gamble.
Yeah, it's all on Robinhood.
That's it. Yeah. When you're talking about this sort of spending, it'll be very targeted, very specific. So it all finds its way there eventually, but it doesn't find its way there in the straight line. And that's where rate of change is. That's probably the most important thing I want to get across to people. Just because you see growth in money printing or money supply or debt or all those things, it's the rate of change that matters. And if that's slowing down on the liquidity side, that means that the juice isn't there to keep these all-time highs after all-time highs to keep going. That juice will come back. The bear market might be much shorter than we're used to, right? We might have a 6-month bear market because it's really just a reset of...
Feels like we had one at the start of this year.
Well, yes, but when you look at the other indicators, there was just nothing. Liquidity was picking up through that.
It was.
The rate of change was picking up through that whole period. It's only really now that it started. There's a bit of generally a 3-month lag. So how I look at it is if we saw the price just take off to 140 today, right? Or very soon, or higher. If we really get that blow off top now, I'd be concerned about that. You actually would need a pullback here to align with where we are in liquidity backdrop. If you see it just taking off, that's that speculative mania that could put in the top and see a short, sharp correction. If we don't see that, that's actually the most bullish outcome if it sort of meanders around a bit and then that still comes later. But there are genuine concerns.
Yeah, okay. That makes a lot of sense. I mean, I've always liked to think about the market as rate of change too as the years have gone on, because when things start moving a bit quickly, it's usually when the emotion comes in, right? So that's when you kind of want to be on the other side. Is there any other sort of cautionary signs that you're looking for at the moment in the data that you think is worth paying attention to? Like, if a top were to come in the next 12 months, like what else could it potentially smell like?
There are a whole heap of risks on the horizon right now. There's always a lot of risks. I mean, that's the nature of global economies, but it feels like at the moment there are a lot of bubbling black swans that will probably be quite obvious in hindsight that are just sitting there. One of them could be that Supreme Court thing we're talking about, right? We get the tariffs rejected, the market just has a tantrum. There are many potential issues. I think the trick is to not fall for doom and be trying to catch that top. What the benefit you have at the moment is, since we've pushed up to those new all-time highs, all the momentum indicators are back green again. So we're early in a new potential 60-day cycle, if you sort of follow that Bob Lucas sort of 60-day cycle work. What I've been saying since the last one that just ended, one of these 60-day cycles has the potential, one of them will be the last one of this overall cycle. So you've got to watch each one carefully. Now, we haven't said that since the 10th of January 2023. That was our start. And then it's only now we're saying, well, now we have to be on the lookout for the exit. So I think that's the main thing I'll be looking for is not to get out too early, to wait. If we saw all those liquidity indicators and the macro really turn to late cycle quite quickly, that would be a sign, sure. But if we don't see that, I think we have the benefit now, while it's at those new all-time highs, to wait for your momentum indicators. So this is where you can get a little bit technical, and start looking at some of those technical indicators and go, well, okay, next time it gives you a sell signal on there, maybe you pay a bit more attention to that one. Where why we've done so well is we've chosen to ignore the signals up till this point.
And what do you make of all the digital asset treasuries that are spinning up left, right, and center? Is that something you'd watch for them as like a private credit bubble that could be brewing as well?
So Jamie Coots, who's from Real Vision, but also Bloomberg, he sort of started their crypto desk at Bloomberg. He's on our investment committee, and he's been looking quite closely at exactly that. He's a bit concerned about what people don't understand about MicroStrategy or strategy versus other Bitcoin treasury companies that really did take risk.
Right, okay.
It's not healthy when you look at some of those other, the broad number of those companies who are approaching it, because they don't have the magic source that Saylor does, where he's doing it on borrowed money and all those other aspects. A lot of them are taking real risk, and their value, it was to do with their valuation relative to their Bitcoin. What happens when that drops below, sort of goes negative? Do they then sell? Does it create a cascading sell environment? Now, that would be very much a technical sell-off, not necessarily related to the cycle as such, but it'd put us all on our... We'd all be on our toes dealing with that one, that's for sure.
All things in all, again, looking at a lot of the metrics you're looking at, some of them can be quite leading. Obviously, we've got a lot of the fiscal policies framework to come out. Obviously, government's sort of shut down over the new year, so no bad decisions, hopefully, until next year. Do you, again, sort of subscribe to this idea that there's at least, however many months ahead of us, like 3, 6, 12 months of things are still going to hold the momentum that they currently have?
That's my base case. So the base case is you stick with it for now, because while the momentum's there, we don't know how high that top can be. And we've seen tops have an extraordinary ability to outperform wildest expectations. So if that happens again, you can't be on the sidelines on anticipation of an end when the data's not there yet.
Right.
Do I think, if I was putting a timeline on it, I do think it could be within that sort of 3 to 6 month period that we see the deterioration to the level that we went, okay, then we would pay close attention to those exit signals, which would be more technical. But for now, we've got a reprieve, because while those momentum signals are positive, then you go, okay, well, I don't have to think about that. I just stay with the market, and they will protect me because they will keep me in. But if we see that waver and we're later in those cycles, that's the signal for us.
That's the signal. I think that's a good place to end it. I think that was good. If people want to follow your work, Chris, where can they find you?
So the best place to follow me is on X at Tipper Analytics. That's probably the best place to find me, but ainsleywealth.com, that's the website I'd go to. We put that report you talked about, that's all up there every week, and all the research that we're doing is out there. So it will absolutely not be a surprise to anyone when we say this is what we're saying is the definitive top of the cycle, and put that sell signal in, because we will absolutely publish that.
There you have it.
So.
Mate, appreciate it. Thank you so much for giving us your insights here today.
No,
and I'd love to have you on again.
I'd love to come along. This has been great. Thanks.
Thanks, Chris.